I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Thursday, July 30th. Welcome to our monthly Global Markets Commentary. July saw capital markets dealing with renewed tensions in the Middle East, the return of U.S. tariff threats, and a family feud at the U.S. Federal Reserve. Still, the setbacks for stocks and bonds were modest and understandable. Across markets, including the S&P 500 and the S&P TSX, gains have broadened and sector leadership is rotating. Major indices remain only mildly below their peaks, consistent with a healthy test rather than a breakdown. In some areas, the pullbacks represent healthy rotations. In others, important tests and displays of discipline. And yet in others, a cleansing of overexuberance. We don't view July's red ink as a harbinger of doom or the makings of a peak for this bull market. Rather, we see it as a pause that can refresh. Despite the list of concerns, the structural trends supporting the economy and asset prices remain intact. The resilience of global growth and financial markets has been tested repeatedly, and July's hurdles reinforce our view that the backdrop remains sound. July brought the U.S. administration's trade agenda back into focus. There was no CUSMA deal, and threats included 50% tariffs on certain Canadian goods, including some expected to fall under the free trade umbrella. Markets largely shrugged off the announcement. Context matters. The new tariffs would apply to roughly 5% of Canadian exports to the U.S. Not insignificant, but not enough to shock the whole economy. The breach of CUSMA exemptions is unwelcome, but the evidence points to this being a negotiating tactic designed to push Canada to bring more to the table. With the tariffs not scheduled to take effect for several weeks, there is room for de-escalation. Trade remains an overhang for Canada, but Canadian financial markets continue to power on. The Canadian economy is not the Canadian stock market. The S&P TSX Composite is up about 11% year to date, helped by large weights in energy and financials. Resource companies face a lighter tariff impact, while financial services face none. Industrials have supported the TSX as well, as Build Canada projects emerge and the economy holds up better than feared. Many tariff-exposed firms also operate plants inside the U.S., where output is not subject to tariffs. The failure of the ceasefire in the Middle East is a step in the wrong direction, but pressure on both sides should encourage a truce sooner rather than later. Oil futures support that view. Prices for delivery 12, 24, and 36 months ahead remain in the US $70 range, suggesting markets are not pricing in a lasting supply shock. Artificial intelligence remains a central equity market theme. Second quarter earnings show the build-out of compute capability continues, but investor scrutiny has intensified. Hyperscalers have underperformed year to date as concerns grow around the scale, sustainability, and future returns of their spending. By contrast, semiconductor, memory, and data center infrastructure companies have strongly outperformed, though with sharp pullbacks along the way. Many key players continue to beat earnings expectations, but stocks that had tripled in a few months have in some cases been cut back by half. Bond investors are also weighing in, demanding more discipline, with recent hyperscaler debt issuance receiving less enthusiastic support and higher yields. This is all healthy. Stock and bond investors are asking the right questions and voting with their capital. Exactly the type of discipline we want to see accompany this fast-growing investment theme. Equities are not being supported by AI capital spending alone. S&P 500 earnings expectations imply 26% growth for Q2. And with roughly half of companies reported, every sector is beating expectations. Earnings growth has outpaced price appreciation, leaving the S&P 500 cheaper on a forward price-to-earnings basis than it was through much of the past 2 years. TSX earnings are robust as well, though it's too early to draw firm conclusions. Price gains backed by earnings growth and many instances of market discipline are developments investors should celebrate, not fear. Despite cooling inflation and expectations of productivity growth, bond yields rose in July, partly fanned by turmoil around the U.S. Federal Reserve. The bond market worries the Fed may not do enough to keep inflation in check. We would not call this panic, but it recalls the old adage, the bond market stops panicking when the Fed starts panicking. Absent guidance from central banks, market participants can overreact to information, and bond volatility is part of the growing pains of a new Fed regime. The past few months have been choppy, but fundamentals have improved. Inflation cooled more than expected in many countries, while employment and growth held up. Shocks can return, but they can also retreat quickly. Meanwhile, a resilient economy soldiers on. That's the way we saw the month of July. Thank you for joining us. We look forward to you tuning in next month.